G'day guys, just thought I'd do a quick video explaining the numbers in terms of what's going on in the property market at the moment. Just to give you my take from probably from a mortgage broker point of view. And as you'll see throughout, you'll see that finance has actually got a big part to play in the property market. I know that probably sounds obvious, but there's some clear links that I think you might find quite helpful when you're trying to determine what the property market is going to do. I'll try to keep it as quick and as simple as possible, but any feedback would be greatly appreciated. I would like to do this quite often and give updates as we go, and probably just a bit more of a focus on property. So yeah, please shoot them through. If there's anything in particular that you guys want to see as well, then I'd love to hear it. So you'll notice that there's the change in property prices monthly, quarterly, and annually. It's just to sort of give you an idea in terms of more recent growth and then kind of how it's been going over the year. If we look in the majority of our customers who are in either Brisbane or Sydney, you'll see that the growth is somewhat consistent in Sydney. So 6.4% for the quarter is higher than the annual growth, but in the last month it's kind of evened out a little bit. Whereas in Brisbane it seems to be heating up a bit more. One thing we're noticing a lot of is that the valuers in Brisbane don't seem to be in line with how the property market is growing. So, which is probably because they haven't seen growth in quite some time, or not at the level that it is. But we think the growth is totally warranted. Property prices in Brisbane are still really affordable. If you look at property prices as a result of median income, it's much more affordable to own a property in Brisbane. And when I say Brisbane, I'm talking up to an hour and a half north, an hour and a half sort of from Gold Coast up to the Sunshine Coast, and then sort of out west to sort of Ipswich area. So I don't necessarily think that the growth is unwarranted. I think it's something that we've been waiting for it for a long time. And as you can see in the median price, 612,000 on average is quite affordable if you're living in Sydney, compared to 1,040,000 here. So I think there's still a lot of room to grow. We're seeing a lot of people relocate to Brisbane, and the salaries that they're paying in Brisbane used to be quite a bit lower than what you would get in Sydney and Melbourne. But they're starting to catch up as well, and that's probably one of the biggest factors when it comes to growth. Are there jobs? Is there good income? Is there good transport? Queensland's been investing a lot in the infrastructure, so they've sort of been almost playing catch up to the other eastern states. But they're doing a really good job of it, and there is a lot of opportunities being created up there. New hospital, new international airport in the Sunshine Coast. So a lot of really cool stuff going on there that would point towards the growth continuing. So I think that's totally fair, and we're just waiting for the valuers to catch up, of course. In terms of the month-on-month change in prices, or in value, sorry. Just looking at this is the combined capitals and regionals, so this is all across the country. One thing you'll notice, so firstly, anything that's above this 0% line, anything above that line means that the property market is growing, or the value is growing, and below obviously means that it's shrinking. Now, one thing you'll see is that from 17 to 19, so if you'll remember, around 17, that was when APRA changes came in and significantly impacted how much people can borrow. And then around 18 is when the Royal Commission started. And so during this period of time, people couldn't actually borrow the amounts that they needed to buy properties at the values that they were at that time. So it was not a matter that people didn't want to buy. It was more a matter that people couldn't buy because the banks were restricting them. So what that says is that the demand never changed. It wasn't a matter of people just decided overnight they didn't need to buy a home anymore. It was purely the banks restricting them. That's really important because if you're trying to wait for the next property, bust or bubble to burst, as people love are in love with saying, or for the next plateau, it's probably more likely to come in the way of regulation as opposed to supply meeting demand. So just during that period, and it's even more obvious here. 17, APRA brought the changes in. 19, the Royal Commission was handed down, and then around July, which is when this growth area started again, around July, Liberal was elected again. APRA reversed some of the changes, and it went up. So there were people waiting to buy. There were people waiting to buy. Now we saw this little blip, obviously, just in that couple of months around when COVID started last year. But once again, that's because people couldn't go to open homes, and there was a little bit of nervousness, but that didn't last very long. Now you've had significant growth, and we believe that there's a big part due to, firstly, people will have a lot more money. I mean, we're seeing clients that maybe used to really enjoy going on holidays and restaurants and things like that. They're now coming to us with considerable deposits. Perhaps weren't able to buy before, now they can, or it's just a focus on property, instead of investing in other areas. But the share market's risen as it was at the same for the same reason. Just people with some extra money, and you notice that companies weren't necessarily performing that well pre-COVID, that would give anyone the hope that that buying shares were going to give them a large dividend or something like that. It was just somewhere to invest that spare funds that they have. But interestingly, what happens when property prices fall? So this graph's a little bit hard to read, but what happens when property prices fall is that vendors tend to get a little bit sort of withdrawn. I mean, a lot of vendors, which is people selling their property, they would list their property on the market to try to get a profit. Obviously, there's people that need to sell. They need to sell to buy somewhere else, and they need to sell to free up cash, or there's deceased estates or mortgagee in possession. There's people who need to sell, and that's in fact what we saw during this period. This little tiny blip here in when COVID was starting, March that year. People who really needed to sell, and then the buyers that were left, a lot of the nervous buyers left, and the real confident buyers, the ones that wanted to take advantage of that situation and weren't impacted by any work changes, they bought then. And just that's a good little key takeaway, because I was talking to a lot of people around 17 to 19, and a lot of people go, oh no, it's not the right time to buy. But that whole thing, imagine you knew. Well, next time that you do see the property market drop and it feels like things aren't going well, and it's going to continue to drop, you might just change overnight, and you don't expect it. So always be prepared, definitely. But back to this, what you'll see, so just during, if you look at the blue line, the 2020 line, this is listings. So this is how many properties are being put on the market. You'll notice this significant drop around April last year. So what happens when well, firstly, a big reason that is because open homes were cancelled. I mean, a lot of people don't want to buy when open homes are cancelled. But you can also look in like overall listings for, if we look over at this next line here, you can see that the line during the thick of the Royal Commission, for example, so leading into around August, just before July 2019, you'll see listings were starting to come down. They're coming down. Naturally, they'll drop during that period anyway. So you'll notice there's a similar line throughout the years as well, but it drops to a lower level. And the only other level that was lower than that was 2020, and there's obviously COVID is a big reason for that. But with listings dropping, what that does is it then means less supply, which means the demand's not being reached, which means that naturally less people selling, more people buying, and then you have that supply and demand again. So then property prices start going up, and then buyers will start to come out again. They start to get nervous, and there's the emotion takes over. It's like, oh, quick, 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 we've got to get in, and it starts to take off, and then it's just self perpetuating. So, I suppose the lesson to learn from that is number one. The property market ultimately will recover. People will sell. I mean, I'll ask, a lot of you are probably property owners yourselves, and the question I always ask people is, well, if the property market dropped by 20%, would you sell your property? And a lot of people say no. So, if somebody's saying like, oh, the property market's going to drop 50%, who's going to sell for 50% less? Unless you really need to. If you have $1 million home and you want to upgrade to a $2 million home, and now it's worth 500,000, but the one you want to buy is worth $1 million. Well, if your loan's more than 500,000, you're not going to get anything from selling anyway. So you just hang on to it. If you can, then maybe it's a good time to buy and sell, but that's going to be quite rare, So yeah, the market generally, will hold its value. There's other things that are going to come into play which we haven't seen for quite a while, like inflation. If you ever think about mum and dad bought a property back 30 years ago for 20 grand and now it's worth $1 million. Well, we'll be saying the same thing. Oh, I can't believe I could buy how cheap a 1-bedroom unit used to be for 700,000 and now it's worth 7 million, that's just the nature and how inflation works. So naturally, buying property at any particular stage, you should do better. But when things do get particularly quiet and it feels like it's the wrong time to buy, sometimes it is actually the right time to buy. But there's a lot of other factors to consider as well. So in terms of then auction clearance rates, so that's a lot of people look at auction clearance rates as a way of determining how the property market goes. Now, there is some kind of link, but the problem is auction clearance rates are going to bounce around because what happens is when a vendor goes to auction, firstly, in a hot market, more properties are going to auction. So, chances are that, during a hot market with more properties for sale, then there's going to be more that are getting passed in. It's just naturally the way it works. But also during a boom, vendors' expectations get grossly overinflated. So they go into that auction probably hoping for something way more than what they can get. So market goes like this, expectations go even higher. And if those expectations aren't met, property gets passed in and therefore, clearance rates drop. So yes, there is a pattern. You can see obviously, around this period of time, from 17 to 19, those regulation changes, COVID in, February, March, 2020, you can see obviously that the property market dropped during that time, and so did auction clearance rates. But it's not the only indicator. There's lots of other things to consider as well. Vendor discount is similar kind of thing. This is quite good, just to kind of get an understanding of each market. But it's basically what the vendor is listed for versus what the property price ends up selling for. This is combined capitals and regionals. I wouldn't take much notice of this because every single market, there's markets within markets within markets. I mean, the New South Wales market is going to be different from the Australian market. Sydney different from New South Wales, and then there's pockets of Sydney. And when we're looking at property reports for our clients, we'll find that this suburb over here, they're selling 20% over the listing price, and then other ones are selling for 10% under the listing price. You've got to look at it as case by case, and you've got to do your research per property because some agents obviously also have different strategies. Some will underquote to try to get more buyers in. Some will overquote and want to negotiate down so you feel like you're getting a discount. Usually the first in the hot market and second in a cooler market. The days on market is an interesting one though. So you'll also notice, so see how the regional, typically speaking, regional areas would take longer to sell. There's less demand. There's sometimes more unique properties. Whereas if you look at capitals, they tend to be a bit quicker because there's more people looking. But obviously during COVID, the whole work from home thing has actually brought those a lot closer together. But definitely you will see that in those areas where, in those times when the property market was not performing so well, once again 17 to 19, and then that little blip in early last year, then it took longer to sell a property. So that's usually one of the first indicators to see that a property market is about to take off. You can see that, you know, this line here, it's sort of leading from August 2020, dropped significantly. It went from, you know, an average of 65 days down to about 35 days. That's a huge drop within a short period of time. So if you can start to see properties are selling quicker, you need to be at that stage. If you want to buy a property, you need to be aggressive. So you need to be, you know, onto that, and don't waste any time. I mean, you know, if a property's listed for $1 million, and you know you go, oh no, I'll pay $1 million, and somebody comes in and pays 1.1, that's what it's worth now. So now your 1.1 million has gone to 1.1. So then 3 months later, you go in for a 1.1 sale and you offer 1.1. Somebody gets it at 1.2. And so it just keeps going like that. So, you know, wouldn't you rather go in at that property for $1 million and pay 1.1 in anticipation for that growth? And now in 6 months' time, you know, you go, oh, you know, thank God I did that. And you know, everybody's going to feel very nervous. Nobody wants to overpay. Nobody wants to get, you know, ripped off. But in a hot market, you do need to be aggressive. You know, in the cooler markets, obviously you can take your time when making offers and go back and forth with negotiating. But in a hot market, you need to go hard. What we find is our clients that have a lot of success, they usually find success 2 or 3 months into looking, because they take that first month or two to sort of feel the market out. They miss out on a few offers. They start to realize, like, oh wow, you know, I need to, you know, I need to be more aggressive. I need to aim a little bit higher. You know, the ideal scenario is that you don't have to do that, that you are prepared to go a little bit higher to snatch that property if you can. But you know, sometimes it's a good exercise to go through anyway. It can sort of really give you some good experience. Next one. Okay. So another one, another indication in terms of property prices is how rents are changing. It's probably not directly linked. I mean, obviously, if rents are starting to go up, that's usually because vacancies are going down, and as vacancies go down, it means there's more demand than supply. So people may start to look at buying. But you know, if you have a look, for example, at you know, at the Sydney line, for argument's sake, you'll see that Sydney's kind of hovered under. You know, it's been reducing, and it was from the 17 to 19 period. Took a really long time before it actually started to go up. So yeah, so in terms of rental income, you know, sometimes there could be less demand on rent because more people are buying. You know, there's also the property prices as they go up doesn't necessarily translate to rental income going up, because that's obviously driven by the supply as well. More, you know, during COVID, we obviously lost the international students that really like to those kind of units around Kensington area. You know, near the universities, if we're talking specifically Sydney, there's downward pressure on rents. You know, Bondi, you know, with backpackers and things like that, there's obviously a reduction in rent. But then the property prices, depending on the type of property and where it was, didn't necessarily fall in all of those areas. So, you know, property prices to fall, just remember that for property prices to fall, people have to sell for less. So if downward pressure on rent means it's putting pressure on investors and they'll sell because, you know, they're not covering the costs, that may happen. But the other thing to keep in mind is that interest rates have been dropping for a really long time now. So investors that maybe were on the line of affordability 5-6 years ago, it's become a lot more comfortable now. So dropping rents is probably okay. But yeah. This is a pretty busy table, but this is pretty much self-explanatory. So just talking about the overall growth, city by city. They didn't have the Perth information in there for whatever reason, but You can see there's pretty much growth in all types of properties in all areas. So this is I don't think this is of any surprise to anyone that's been somewhat interested in the market, or anyone that even owns Facebook or a Facebook account or watch the news. It's pretty widely publicized, but it's a hot market. In terms of what I personally think going forward, I think they'll start to slow down a little bit in terms of growth in Sydney particularly. It's all to do with affordability. You could look at a diamond, for example. If you want to pay $1 million for it, but you don't have $1 million, well, guess what? It's not going to sell for $1 million. So if you have a bunch of people in a room and the max they can pay is 500,000, and in their mind they think it's worth $1 million, well, it doesn't really matter. They can only pay 500,000. The same goes for houses. They can keep going up for as long as people have the money to keep paying more. And so people are definitely getting close to reaching their maximum borrowing capacity. So it's natural that it will start to taper off a little bit. I did show you those graphs of what happened during the regulation changes from 17 to 19 as well. Obviously, the pandemic in February, March last year was quite unique, and I think people were taken off guard. This time, even when lockdowns hit Sydney and Melbourne, property prices didn't drop because people go, oh, well, this again, and they realised that was not necessarily going to have a downward impact. And you can thank the government for that in terms of being able to keep the banks lending. But that's what it all comes down to: how much money can people get? So if regulation changes do come in, then yes, you can expect it to slow and potentially even drop. But I personally think that the regulators are going to stay out just for a little while longer, and I think they're going to learn by what they did 17 to 19. I don't think they want to have that kind of impact on the property market again, especially given that the economies relies so heavily on housing. But anyway, I hope I didn't bore you too much, and I hope that you found this helpful. And we'll do another one of these in a quarter. But any feedback, I'd love to hear it.